Hi, I'm Dan with Pay Down Debt Solutions. Today we're looking at some examples involving 30-year mortgages. A lot of people are up here around the 7% range. I know it came last year, and we're still right about there now. We're somewhere in the 6.97, 6.91 percentage range for the average 30-year mortgage rate across the United States. And very soon, typically within 4 years, these are interest owed after, so it's after 1 year, paying. Just to give you an idea what this board is, but you will start seeing it. As soon as you get about 3-4 years in, you'll start getting things to refi. Hey, take money out. What they'll do is they'll say, hey, you've done such a good job making these monthly payments. These aren't your payments. These are interest still owed after a year's worth of mortgage payments, after 2 years worth of mortgage payments. Given those 7, 6, 5, 4, and 3% mortgage rates on a $300,000 30-year mortgage. So when you get there, they're going to say, hey, you've gained some equity. You've done such a good job paying. We're going to give you a percentage. We're going to drop you. If you're at 7, we're going to drop you down to 6%. Let's say after 4 years, you can take out $50,000 in cash. Now, if you got a little debt, and this is the first time you're seeing us, that seems good. Hey, that 50 grand I can really use. But what does it actually cost you? So I gotta get my trusty notebook here. There's too many numbers for me to remember off the top of my head. I definitely don't want to explain it to you guys. But you can see after 4 years, on that $300,000 mortgage, this is the total interest you pay for each percentage, 30-year mortgage, each percentage. You can see after 4 years, let's round that up to $337,000. You've paid, let's see, 63 and 19, $82,000 in interest. And in principal, you've only paid $13,576. That's how much principal you paid down, right? But you paid $82,000 in interest to get that $13,000 down, because we always tell you mortgages are front end loaded with interest. So you see that $50,000 and you think, hey, that's great. So what's your monthly unit payment change? That's also how they get you too. They go, hey, look, we're gonna lower your percentage rate. Lower interest you're paying is better. And look, your monthly mortgage rate or mortgage payment is only going to change very slightly. What's it go up to here? Make sure I get my numbers right. That's 6%. Anyway, I know that I wrote that one wrong. That's a problem. It's only going to go up to $2,017. You think, wow, look, now I was at $419,000. Excuse me. We got down to $306. This is just the interest, not the principal. The principal's only changed by that $13,576. So you think, wow, whole percentage down. I take 50 grand out. Amazing. I pay off a bunch of that debt I have, credit card debt. You're thinking this is a good deal because you haven't studied pay down. You haven't seen us. Maybe this is the first time you're seeing one of our videos. Maybe it's the first time you're even thinking about something like this. You're like, hey, my payment only goes up $21. That's got to be a pretty good deal. Now, obviously, it's not this because that's the $300,000. But now, what are you actually financing at 6%? You're financing at 6%, coincidentally, maybe mathematically, almost that amount. So what you're going to be financing, because you only paid $13,576 of principal, you're going to take $50,000 out, and I'm going to, just for the fun of it, I'm going to leave out all your closing costs, because I'm just going to do a straight comparison, because we would have included them all in that $300,000 initially. So you're going to do 6% of $336,424, right? And where's that amount come from? Your mortgage started at $300,000. You paid off $13,576 in principal. Now you're taking $50,000 out. It seems like a hell of a deal. Pay off all that debt. You're going to finance $336,424. That's your new total mortgage at 1% lower, right? So 1% lower. Now your total interest on the loan, remember, that's your principal, your financing. Your total interest is going to be $390,000. I rounded it up a few $100. It's $390,000. So this is why the banks do it to you. They've already got $82,000 of you in interest that didn't cost them anything, right? Because you paid all the fees, all the closing costs. You already paid $82,000. You took $50,000 out after paying only $13,576 down. So now your interest resets to $390,000. So you took $50,000 out, and how much interest did you pay or save? What's it? $419 to 90? Right? You guys know. $29,000. You took $50,000 out to save only $29,000 in interest. That's why banks do it. That's why they're going to continue to do it, because they're going to continue to incentivize it, right? They're not in the business of helping us. That's marketing. They're the only game out there. So what do? They market how it's helping you. Look at that. We're going to give you $50,000 to pay your debt down. Now, we can always make the argument, oh, hey, those credit cards are higher interest. Yeah, but if you learn the pay down method, you'll learn those higher interest cards. You're never going to pay that higher interest because of how you're going to structure your personal finances using just the tools you already have. If you're lucky, you qualify for, let's say, a lower interest, better tool. The tools are revolving lines of credit, right? In case this is the first time you're coming to us. But this is what the banks do. And this isn't, this isn't like dark marketing or they're trying to trick you or anything else. They just don't tell you all the numbers. They don't tell you the actual facts. They tell you what they know will attract you. We're going to drop you a percentage because for 4 years you've dutifully paid on time. We're going to give you $50,000 out for whatever. Take a vacation to Alaska. Take a vacation to Hawaii. It's your money. It's your equity in your home. You've reset your mortgage 4 years more into the future. You've taken $50,000 out now. It's costing you. You only saved $29,000, so you lost there too. All because they advertise that 1% change. Yeah, that's better. And it's only $21 more. So you're losing on every angle, excuse me, when you're only 3 or 4 years in. Now, if you're clever and you're looking at this, you can see where there are opportunities to do it. Say you're 3 or 4 years in, and once that interest drops by about 2%, if you do the equity game, if each time you refinance, you take money out, this is never ending. I don't want to say there's no helping you, but until you really understand it, really look at it and go, wait, what am I doing? I keep taking money out. It's the mortgage. You're going to have a mortgage forever. And your payments are going to keep ticking up because what you're financing is going to keep ticking up. Your principal is going to keep going up, but because they lower that percentage on you, your payment's not going up that much. So it looks like, wow, what a deal. But you're really not saving anything. Especially, excuse me, I got one of those little dry spots in my throat that won't go away. Especially when you look at the pay down method and how closing costs on a $300,000 loan could vary anywhere from $6,000 to $18,000, depending on where you're at, fees, property, excuse me, value of the property taxes and all that sort of thing. You're going to look at all that. Now, when there's a rule of thumb, generally about 2%, you want to look at refinancing, but look at the actual costs. Not just the cost now. And I know, say you're 35 years old, you think 30, I'll be 65. Believe me, as you get older, knowing like, oh, if I could go back and just ground through it, done the pay down strategy, chunked down my mortgage, even though I didn't have just wads of cash, but if I did the pay down strategy and I worked this, I'd already have my mortgage be paid off at 65 instead of doing this a couple times. Now you're like, I'll be 75 before it's paid off. Like this is never, mortgages don't have to be a lifetime commitment. If all you can afford is the minimum payment, or you're too, let's say not lazy, but let's just say you're not motivated enough, because you gotta be motivated to do pay down. Not big motivation. It's not that difficult. The initial effort is just going to be in figuring out where your money's actually going. All your personal effort is going to be what bills do I actually have every month? How much cash do I have coming in? That's the easy part. You can check to see what your paychecks are, what your retirement income is, veterans benefits, that sort of thing. You can see all that money coming in. That's easy. And if you don't want to go through all your bank statements, I constantly see ads online for apps that'll tell you, because lots of people are paying. I found I was paying 2 Netflix subscriptions. And I don't think none of my friends were scamming me. Somehow I had 2. I have a feeling one of my kids did it. I just don't have the tech savviness to prove which one to ground them for the rest of their lives. But you can figure it out. That's all your initial effort. Once you set it up, it's like one bank transfer a month. That's all your ongoing effort. Or just pay the mortgage for the rest of your life. Never get away from it. Never get it out. I know you guys aren't tuning in. The people tuning into something like this don't want that. They want to get out from under debt. They want to get out from the stress, the anxiety. They want to buy what they want to buy. They want to do what they want to do. And I'll give you an example of how pay down with not a big differential in your available income, which is your total income minus non-chargeable expenses like a car loan, student loan, rent, or mortgage. You don't even need a big differential. You can get a convenient, once you get your debt down to zero or near zero, you can do a convenience check and you'll see how chunking this down, using that convenience check and the pay down strategy to repay that money you're putting on your revolving line of credit with that check, how you can come out ahead and still shave months off your mortgage, not add months to your mortgage. And that's what this is all about. Money in your pocket as fast as you can increase your cash flow and pay down your debt as fast as possible. I don't want to say so you can go in debt again, but so you can start doing and enjoying life more. More options. More things available to you. And I've realized now, I'll be 48 this year, I realize now that my money is better spent creating experiences with my kids and my wife than it ever is buying them anything. I've watched it, oh gosh, I can't even tell you the number of Christmas friends you watch them love for the first 2 hours, and then 2 weeks later, you see it underneath their old toys, which means they've been using their old toys more than that toy because they're piled on top of it. I know any other parents out there has experienced it. I'd much rather take them somewhere, let's do something. It'll be so much more fun. And with more cash flow, there's more things you can do. I don't want to say funner things you could do, but there are. Like I screwed up daddy-daughter dance scheduling and it got booked up. So instead I took my daughter to indoor skydiving. Fortunately, she loved it. Not a cheap endeavor, not crazy expensive. I think it cost her like $70 for 3 minutes. It cost me $70 for her 3 minutes. Absolutely loved it. Unbelievable. Watching her in there skydiving with an instructor. What a cool thing. And I'm waiting to take my son. My son wants to do it for real. He's only 13. We said when you're 18, you can go do a real one. Let's at least get him through high school alive, right? The bare minimum. Let's get him through high school alive. Then he can live his life. Anyway, I'm going on tangents because the kids got involved and doing fun things with the family. I'm going to show you an example of how like those $6,000 to $12,000, $82,000 in interest. Look at all these numbers. But you see some advantage like, well, hey, if I'm 4 years in, and I do that 5%, I go down to 280. That's a heck of a savings, even after. But mortgage rates, it's gonna be, if you just got this, it's probably gonna be a while you hit 5. Do I hope we all hit it in 4? Absolutely. Is there a chance? Of course there's a chance. No one can predict exactly where it's gonna go. But you have to have the foundation, like a pay down strategy, not so much to take advantage of it. They're always sending you brochures, not to take advantage of it, but supercharge it. Don't just go, hey, I'll just sit back and I'll wait. Interest rates will come down. No, start now. Start lessening your interest now, just in case. That's your insurance policy. Setting up your finances to put more money in your pocket and increase your cash flow will supercharge anything you do here. The market moves in your favor. If it moves against you, you're solid. You've got your 30-year fixed. You've got your pay down strategy. You're never going to pay this. Doing the pay down strategy, you're going to avoid all that. Then if a big opportunity like, well, hey, I started at 7 and obviously this chart goes out to 30 years. You can just go to something like, I use calculator.net a lot. Go to calculator.net, plug in your numbers, look at the annual amortization, go, okay, let's say it's 10 years. 10 years out, where are you at? Then compare it and go, hey, they're offering 5%. Just don't fall into that trap. When they start sending you something like, hey, take some money out, we're going to lower a percentage. Look, your payment's going to barely go up. This is the trick they're playing. This right here. And it's not meant to trick you, it's just meant to distract you. If they're tricking you, I don't know, legal stuff, that'd be like fraud. They're literally tricking you. No, they're not tricking you. They're just saying, hey, we took care of all this for you. All you got to worry about, $50,000 cash. We go right to your account within 5 days of that closing. Your payment's only going up $20 a month. It's a win. Well, it's not a win-win. It's a big win for them. And you are almost fooled into thinking it's a win for you. I'm going to cut away. When I come back, I'm going to set up this 7%. Say you're 4 years in. Say they've got close to a zero cash flow, and we're going to work it and see how much we can save them before they even get to this hypothetical. Say 4 years. Say the interest drops. We want to get to where you're already avoiding all this. You've already chunked this down so much. You're like, yeah, it seems like a better deal, but I'm 4 or 5 years in already on my 30-year mortgage. Why would I want to add those 4 or 5 years at the end? I save this money. I'm already chunking it down. I'm never going to pay this total anyway. To where your time on that mortgage, or where you're going to be in 30 years, 55 or 65 or 70, depending on when you're doing this mortgage. Heck, maybe it'll be 95. Maybe you're older. Hell, I'm 48. Maybe it'll be 78. Like, I don't want to add any more time. I'm regretting it already. Oh my gosh, we bought our first house for this house. I'm in. We did an addition on it, but 23 years ago, I'd almost be done with the mortgage, but twice we refinanced. Once to lower the payment, and once we did a refi to put an addition on the house after having 2 kids. Oh, I regret them all. My wife doesn't regret the space because, as the kids get older, they get more annoying. I mean, mine are little. Mine are 13 and 8. We can already see it in the 13-year-old. He's already starting to get annoying. And I got good kids. Don't get me wrong. All right, let me cut away. I'm going to set this up and show you how 6 or 10,000, even with a higher interest credit card, how you chunk it down and use the pay down strategy to then pay down. That we'll call a convenience check as opposed to a home equity line of credit. Jen really enjoys doing the home equity line of credit, so I tend to avoid that to leave her more stuff to show you guys. I'll just use a credit card, and we'll see how you're never going to pay that $419,000. You're going to cut more years off to where even if you get that nice big drop and you look at this, that big difference, $56,000, it's not even going to appeal to you because why would you restart? You won't want to restart. All right, I'll be right back. All right, we're back. And going over that first video, just to make sure for continuity, I realized I left something out. If you remember the board, I put by 4 years on that 7%, $300,000, you paid $82,000 in interest. And I went over here and go, here's your new finance. If we're taking $50,000 out, you saved $29,000 in interest. I left out the key, one of the keys of how this. So I can explain how it affects you, but why the banks do it. So what happens is you save $29,000 interest. You've already spent $82,000 interest on that your initial 30-year $300,000 mortgage at 7% after 4 years. 82 minus 29 is $53,000. Now I'm rounding to the nearest dollar. Other things, when the money comes in and out, i.e., like on this example, I'll show you like when you originate it. This is, you make that a $5,000 principal per year 1 year later, because it's very important when the money comes in because it's compounding interest working against you. So when you take that $29,000 saved, you spent $82,000. That means, and they gave you $50,000. Really, you spent $53,000 in interest for them to give you $50,000 back in cash to pay bills. It's always working in their favor. If you don't pay these down faster to save on the compound interest, it's kind of like a casino. It's always in the house. The house always has the advantage. The longer it goes, the more months the loan carries out, it makes them more money. It's always in the house's favor, in this case, in the bank's favor. But let's look at this example. To avoid that, because this is kind of being forewarned is forearmed. This will happen. You're at 7%. You get about 4 years in, you're going to start getting these deals. They're going to go, hey, we'll drop your percentage. You'll get $50,000 out. You've been such a dutiful, dutifully making your monthly payments. So let's look. If you can afford $5,000 principal a year, now you don't have to have the $5,000. If you remember the pay down strategy, you set up your finances using Velocity Banking. You got a 23% credit card. You get a convenience check. You're going to pay that 3% fee, give or take, say 2 to 5%. You're going to have $5,150 on your credit card. Now, each year you do that annually, and I plugged in all kinds of numbers. I had to get really crazy high, like 29%. And then what it really comes down to is how much money you're how much of your available income is putting down your credit card versus your chargeable expenses you have left. that differential. But in all but extreme scenarios, the interest was less than $1,000 and less than 12 months. So this that's why I picked 5,000. I picked 10,000, right? I could pick 20,000. I picked 5,000 because for most of the budgets we deal with, most of the people's finances we deal with, once they get their credit card debt paid down, not necessarily paid down to zero, but paid down where they're managing. They're way over the hump. They're getting close. This 5,000 a year is doable. And let's just round up. Let's just say it costs them still $1,000 a year, right? So let's just take $1,000 off each year, right? It's simple math. I don't want to keep writing it. Right here, it's technically 18,000. And you'll see in a moment why I picked 18 down there. What's the significance of that? Oh, I'm sorry, it's not 18 anymore. I had plugged a number in wrong in the calculator, and I always go back and double check everything, and then I caught it. So it's almost 11, 30, so that's 19. 19 years. So let's look at it. So for this, let's say you originated it December of last year. That 7%, that mortgage, that 30-year, $300,000 mortgage, 7% interest. I should write that right here. It had 7% interest rate. Your total interest in that was going to be $419,000. So if they're 1 year, if you originate in December, if by next December you can put $5,000 on it, you'll save $30,802 in mortgage interest. We're just going to say it costs you. I know it's going to be less than $1,000 in nearly every case. So it's going to save you $29,802, but it's going to cut 17 months off your mortgage. It doesn't seem like a lot, but believe me, 30 years goes by fast. You hear that all the time. What they don't tell you is every year you work is one less, is like the feeling in you of not wanting to work anymore grows and grows and grows. And I guarantee you after 30 years, it will be monumental. You'll be so tired of it. And I started working full-time I had 3 older brothers. I was 13. I started working in the summers every single holiday. This isn't about me, but I was burned out by the time I was 40. I'd already had almost 30 years in. And I was nowhere near done. I'm still grinding. Like all or most of you. So this is just the credit card interest, just doing that. Take that convenience check, dump $5,000. 1 year after 1 year on your mortgage, that's what you're going to save. If you do it the second year, your savings are going to grow to $56,127, right? Technically, this would be minus $2,000 now because these just added. So really, it's going to be $54,127. You're going to cut 2 years, 9 months off your mortgage. And I'll just get out of the way. You can look at the numbers. I can just read them to you. It's a waste of your time. It's not so much a waste of my time. My time is your time. I'm trying to teach you guys not just the math, but how to think about your personal finances, how to see the angles, the opportunities. So when you use the pay down strategy, using velocity banking, and you start getting these things in the mail, you start going, yeah, this looks good. Now there's going to be circumstances. Medical happened, something tragic happened, or just some unforeseen thing that happens in everybody's life. You may have no other choice. If you have no other choice, just know you can always fall back on the pay down strategy to get you back out of that debt, to get you back on the right track that you chose for yourself. So let's look. If you made year 3, right? This actually looks like I failed to write 1,000, so I'll just write it. It's supposed to be a little quotation to mean carry the number down to the next line, what's directly above it. So we'll just look at it, but it's cumulative, right? So after 3 years, if you manage, you put 15,000 down. Now in 3 years, there's not a whole lot of investing unless you like to speculate on crypto where you're going to invest 15,000 and your return will be $74,180. You're cutting almost 4 years, 3 years, 10 months, almost 4 years off your total mortgage payments without having to refi, without having to do any of that. And if you need that 50,000, check out some of our other videos, look at the pay down strategy and know you're set up in that revolving line of credit. If there's things you're like, well, wait, that 50 grand, what do I even care? I don't care about any of this. Look at the pay down strategy. Look at how you can get that money out using your current tools you have available to you. How you can pay it off fast. You don't have to worry about the total interest. You don't have to take a loan. Always a line, never a loan. Right? 4 years. Now you've done $20,000. You've invested in yourself. You've invested into yourself because you put this down on your principal of your mortgage. You've saved. $90,813. I know it says 94, but I got to subtract each year's interest on each year's convenience check, right? The annual interest, because you're going to get that convenience check on your credit card, get that $5,000, put it on your mortgage. Now you're still paying your mortgage down. You've got that balance on your credit card. Don't be afraid of it. That's why I already did the math for you. You're not going to be paying that 23% using the pay down strategy. That's the beauty of this, our strategy, right? 5 years in, you've now invested $25,000 into yourself to save money, which there's two ways to save money. Invest, get that extra return, invest and save all the extra interest that's going out. That's what this is. You're saving all that money by investing $5,000 into your mortgage against the principal. You're saving, now I'm sorry, $25,000 because we're at year 5. That $25,000 investment over 5 years, $5,000 a year annually, will save you $104,656 and cut over 5.5 years, 5 years, 7 months, 5.5 years off your mortgage. Now, let's say you get some momentum. 1, 2, let's say, honey. That's if I was talking to Jen. No, your partner or you on your own, you gain momentum. You're like, yeah, let's do this. I like this. I like being in control. I like knowing where my money's going. I like seeing, just, even though you can't see it in your account or, say your stock portfolio, just go into that calculator.net, plug it in, then you'll see the money. You'll see these numbers adding up every year. I know it's hard because it's long, kind of a long-term gratification thing, but see it for yourself. Go in there, see the actual numbers, look them up, plug them in yourself. And I always push calculator.net. It's free. I don't want to sound like I'm running an ad for them. There's no endorsement. There's nothing like that. I just repeatedly, I end up keep using them as a calculator. You'll see what happens. They've got a way you can put in all your information, and then you'll pick, annual lump sums. You'll pick up each month, or you can plug in, hey, what if I just do a little bit every month? You can see, it'll instantly pop up. Boom, this is how many months. This is when it'll be paid off compared to the 30-year. Where your 30 years ends up, the 360 months. And it'll tell you how much interest you save for any little step. Play with it. Because that's what I did. I picked the 5,000 because I know how average, I know how kind of most of the customers we look at, how kind of the average is for everybody based on available income, chargeable expenses, how fast they can work that down in their credit card with the pay down strategy. So look, if you really stay dedicated, I'll go back to where I started. If you get really dedicated, 19 years, you're going to invest $95,000. You're almost doubling your money. Not quite, but if you're going to save, actually, I'm sorry, you don't double your money. You about break even. Because if you kept doing this, and you kept saying, remember, I rounded up. Almost all the scenarios I had were under $500. I want you to be pleasantly surprised, not negatively surprised. This is the most blanket I can do that I'll apply to most of you. The vast majority of you, let's say, if you were using the pay down strategy. Otherwise, it's just, hey, if you guys don't have any debt, just look, how long do I pay that $5,000? Or how long do I save it? And then I start doing it. And then, hey, I can save it again this many months. Boom, I'll do $5,000 again. So take $95,000 off of this. I'd like to do that in my head. I'm a little tired today, so I'm a little slower than usual, which isn't very fast to begin with. So man's got to know his limitations, right? So the interest, you're going to save $93,000. That can't be right. That doesn't make any sense. This isn't the right number. I'm going to go back to calculator.net. I'll do an addendum if you like, but I probably double flipped a number. When I went back and caught a correction I made, I probably accidentally changed that and made that incorrect. But this will give you an idea. Do that $5,000 annually. I carried it to 5 years because by 4 years, the mortgage companies are going to start sending you that. They're going to start saying, hey, we're going to lower your interest rate a little on that 30-year, and we're going to give you cash out. It's your lucky day. It's not your lucky day. It's always in their favor. All that marketing is in their favor. Banks got shareholders. Shareholders want to see a profit. They profit off, you could say, our backs, not directly. They profit off of your lack of information, your lack of knowledge on looking at this, how banks are looking at it, why they're doing it. Good news is you don't have to. This is how I spend my free time. I don't know if that makes me a dork or a nerd. I know I'm a dork. I don't know if that makes me a nerd, but this is what you're looking at. I'm gonna cut away for a split second before I do my send off. I'm gonna double check this because it drives me nuts because I know this can't be right. Oh, I did write it right. Sorry to everyone out there. I had it originally. I caught the mistake and reversed it in my head. This is 19, so it's $19,000. The interest for those convenience checks if you do it that way. Obviously, you could save if you can do it bigger and faster. Yeah. So now take 19,000 off of 188, and you get what? 169,530. So you invest 5,000 annually. 19 times 5,000 is 95,000. Plus that 19 that cost you in convenience check fee plus interest as you were paying down each chunk annually. So that's 114. So 188, you saved $64,000 if you carry it all out. But that's kind of adding apples to oranges. Really, we're just looking at the interest you're saving, because this is always going against your principal, which you have to pay no matter what. That's all. You're always paying the principal. We're trying to save you on interest. So look at that. It costs you $19,000 interest to save $88,530 on your mortgage, which is right $169,000. How do you beat that? I'm sorry, I conflated the two. That doesn't count towards your savings. We got to do interest to interest. We can't bring principal into the equation. That's how fast you save. 10 years, 10 months, almost 11 years off. Man, just $5,000 a year. I love it. I hope you guys like it. I hope you enjoy the video. Please like and subscribe if this brings you value. If you just go, meh, I've seen it a million times. You can subscribe if you want to give us another chance. But we don't just need subscribers. We're trying to actually create content that teaches you guys not just simple math, like you just saw me accidentally add apples and oranges together, which you can't do. You gotta stick interest to interest, because that's what we're comparing. We want to teach you methods to help you learn how to think, not think for yourself, how to think, or in what way to think for yourself. I keep coming back to that, but you get the point. When you get these offers from banks, think, how is this benefiting them? Because if you just look at how it benefits you, that's where they benefit. That's what you not looking at things like this, not rewind, go back to the original sheet. That's how they're just selling you how it benefits you. It benefits you, but really it's not benefiting you. At best, you're breaking even, but banks don't make offers that you get to break even. They profit off their offers. You don't. They cost you money. They're just packaged in a pretty bow to sell you on them. I'm Dan with Pay Down Debt Solutions. Always aligned, never alone. Thank you very much, everybody.